Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, September 10th, 2021. And our top story today, the SEC takes a further look at the Robinhood business model. Well, joining me now to discuss this and a lot more is Dave Banerjee. He is Chief Executive Officer at R&D Resources. Dave, so great to see you again. Thanks so much for joining us again this morning.
Thank you very much, Jeff. Glad to be here.
Yeah, and I love when we get a chance to talk because we get the chance to talk about compliance, which I know is a passion of yours and something you have done for a long period of time. And I want to revisit our conversation about GameStop, Robinhood, and the SEC. So let's get a quick update. Where do we stand with the Securities and Exchange Commission investigation into GameStop and Robinhood?
So the SEC cannot prohibit individuals from trading, what they would prefer to do. What they do have control over is the short interest element, and to be able to limit that. And people have circumvented the locate requirements for shorting. So you cannot short blindly. You have to go to your custodian and ask them to verify that they can locate the stock for you, to lend to you, to sell. And people have circumvented those using derivatives, options, and sometimes even blatant what we call DKs. That's trading it, but not intending to settle the trade, for people who are momentum traders. So that has been the focus of the SEC. They haven't come up with any clear guidance as of yet, because some of the instruments that are used goes beyond the SEC into the CFTC's jurisdiction. So there's a overlap between regulators. So they would like to plug the low-hanging fruits in terms of imposing on custodians the ability not to short an item prior to the stocks being located first. Yeah. And those stock locations are based upon other investors that happen to have that stock in their margin accounts. So that's how that works. So having a meme stock in a cash account would not lend itself to shorting or being borrowed against by a custodian. It's only when you put them in a margin account. So,
Dave, how prevalent is this? I mean, I know that a lot of this came to light when we started talking about AMC and GameStop, and then Robinhood kind of cut off the trading, which I think they were required to do. That, I guess, quote unquote, cause losses for people. But how prevalent is this behavior? And well, answer that first, and then I have another question regarding gamification. But why don't you address that one first?
Well, it's off and on. The recent items regarding the meme stocks is unusual. I don't think in my 40 years of experience I've run into such a large variation or a large interest in such stocks. We've had issues with locates, and that regulation has been driven. It used to be that you could get a negative confirmation from your custodian before shorting. Now it has to be a positive confirmation. The custodian has to get back and say, yes, I have access to those stocks for you to short the stocks. So there's been minor changes, but it's not, I wouldn't say it's not without precedent, but unusual.
Yeah, and let's talk about gamification, because I know you and I think, and I don't want to speak for you, I'll let you clarify for yourself, but I think we have some concern about the gamification, if you will, of trading and investing. And a lot of these people that are on Robinhood and other similar apps are new investors. And while that's good in one sense, if you don't have the investment knowledge and don't understand exactly what you're doing and the instruments you're using, you could find yourself in a world of trouble here, Dave.
That's quite prevalent, as a matter of fact. My major concern is that a lot of the retail investors, I wouldn't go so far as to say they're not educated. they pretty much understand what a loss is. Everybody understands when they lose money. Nobody wants to
Yeah,
lose money, right? But
absolutely.
the difficulty is they get drawn into um, these platforms that make it look like they're playing video games, when in reality they're actually putting up grocery money, in terms of gambling it. Now, we all believe that it's the retail stocks that are driving it. However, there's a segment of, I won't call them professional traders, but marginal individuals that are borrowing money from individual investors and gaming the system, promising quick and easy, exorbitant returns. Now, a large number of them are not registered, so they don't come under the SEC. The SEC does have broad powers, and they're looking or searching for people that do this in order to stop them from doing it. But in my 40 years of experience, there was a period where it wasn't unusual for gamification to occur. And there was a number of strategies, at that point, where there'd be broker dealers or actual institutions set up with trading computers and trading platforms like an internet shop, and will bring in retail investors and permit them easy credit in order to engage in momentum driven trading. So,
Yeah, it just makes me very nervous for obvious reasons, and especially when you have unregistered people, I guess, consolidating money and doing
correct.
trades, and I don't even know what those agreements look like. I mean, are they formal agreements? Like if I give money to Jane Doe and Jane Doe is trading for 10 people, do they have a separate agreement? Is that agreement covered under anything? Is it a legal agreement? And that comes to me about thinking about who's an investment advisor, who's not an investment advisor. I have to think that Chairman Gensler and the rest of the SEC, they have to be looking at this really hard and saying this is a real big concern.
It's almost like, if you get away with it, you get away with it. On the face of it, is it illegal? No. The agreements tend to be very common promissory notes that you could get at a stationery store. They're not subject to one-on-one loans, and promises are not deemed to be securities. So they avoid a lot of the regulations. And to the extent that you get away with it, you get away with it. And if there is a complaint that is filed, to the extent that it was done by unregistered people in instruments that are non-securities, it basically puts these people in the civil courts, as opposed to a arbitration or the use of administrative law. So
yeah. David, I need to take a quick break. When we come back, we'll talk more with Dave about compliance, regulation, and more about these meme stocks. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. and we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score, a credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Dave Banerjee he's the Chief Executive Officer of R&D Resources. Dave, thanks so much for staying with us this morning.
You're welcome. Thank you, Jeff.
And again, I should stress, we are not giving enough time to what is arguably a very complex and important topic. Dave, just in between segments, I was thinking about all the TikTokers, the Instagrammers, the Facebookers, the LinkedIners, and the subredditors who are sharing stock and financial advice. Where does that come in under the umbrella of the SEC and some of the state regulatory entities of financial advisors?
So there's nothing to prohibit people from talking to each other regarding stocks, right? In terms of their preferences, individual preferences. The SECs and the states authorities basically drive a wedge that basically says if you're doing it for a living or if you're doing it as a significant part of the time that you have available, then in fact you're acting as an advisor, irrespective of whether you get paid in advisory fees or not, or other forms of compensation. And sometimes, and that mentality has changed where compensation is not really a key criteria. But if you're doing it for a living, and as a matter of fact, a lot of this, the CNN and the ones that we old folks are used to, which is TV and people touting stocks and talking about the markets and individual securities, the SEC and the state regulators watches them very carefully to see if they cross the line. And we'll go back to them and say, look, you're now engaged as an advisor and you need to register. People who thought they were great investment gurus and wanted to start a hedge fund, the SEC came in and created a category called an exempt advisor and now requires them to register in a very short form, but puts it on the radar for them. Yeah. For the rest, the SEC is dependent on whistleblowers, on people providing tips. And most of these tips come from people who obviously have lost money, have found out that they cannot use the regulators, have gone through the civil and either are unable to pay for the legal representation or have lost in court, and they end up being whistleblowers. And the SEC and the regulators follow up on that. I know the state regulators are far more adept at following up on customer complaints than the SEC is because of the backlog. But what people need to understand is the state has securities regulators that are available to the public.
Yeah, and I think that is, I think what's concerning is that look, so clearly, like the IRS, the Department of Labor, I mean, these federal agencies don't have a lot of human capital to deploy to follow up every investigation. That's where the states come into play. But it almost feels like, to use an analogy, like the Wild West. If you remember, the stories of Wyatt Earp and Doc Holliday and people like that. I mean, that Wild West was unregulated, and you had, basically vigilantism it kind of reminds me in a sense of this, is that you have this whole new world of trading, and in a way it's unfettered and unregulated in a way that protects people, the average person like you and I, from getting hurt.
I love the Wild West. I love Wyatt Earp, and I love to gunsling. But the point being that it's not really a remedy, or a regulation isn't really a remedy. The remedy is to permit the markets to define it. So if you are, for lack of a better word, lack the wherewithal to be able to engage in that kind of business as an adult, you should be aware of the risks, or you shouldn't be engaging in it at all. And if you do engage in it and you miscalculate the risk and get burned, you should have known that going in. So as I indicated in the last segment, there's two competing objectives of regulation. One is orderly markets, and the other is investor protection. And this is a unique situation where both of them are at odds with each other. If you want to maintain an orderly market, you have to permit for a little bit of investor non-protection. Mm-hmm. If you focus on investor protection extremely, you upset orderly markets. Because when you put regulation on orderly markets, it's a form of tax, and it's monetary, pecuniary, fiscal, everything.
So Dave, and I agree with you that regulations can just gum up, these are my words, gum up the operations. How do we educate people? I think it just, to me, it always comes down to how do we make people better consumers? Meaning, how do we get them to make themselves better consumers? Because I'm not going to be able to tell anybody, okay, well, this is important. You have to be able to prioritize. So where does that come from? Does it come from K through 12? Does it come through college? Does it come through vocational? How do we get people to be better investors so they know not to get tripped up? I mean, there are always going to be some people that get tripped up, but in terms of providing insight into, investor education and making sure people understand what they're doing, how do you do that?
I strongly believe, and I don't think anybody should run with this, that education should start in middle school, early middle school. There should be some education related to basic savings, fundamentals of stock market, risk-return relationship, and understanding terms. We get very much clogged up in the use of industry terms, which we assume everybody knows what they mean, without explaining the full breadth of what's underneath of that. So terms are like the use of mathematics. We memorize multiplication tables as a mean of an extended addition, So we tend to lever off of terms without really communicating. We may both speak English, but one does not understand. So a little bit of that education should begin at the mid-school level. And I strongly believe that for a segment of the population that may not have gone through the US educational system, or may have skipped or missed it, when their children come up to them and be educated, sometimes we learn from our children. Like you started off our discussion talking about my son. There are terms when I do read about him and read what he writes, and I learn from it. So I think kids become the son of man, right? I mean, at some point. So it should be a part of our education system, right? Yeah, it shouldn't be left to a CFA. So.
Yeah, I agree with you. And I mean, you're mentioning terms, and you've been in the compliance field for 40 years. I mean, there are a lot of terms, I think about beta and alpha, where we all probably understand, not all of us, but beta is a measurement of risk. But what is really risk? What does that actually mean? And so I think a lot of stuff gets thrown around. And I think you read some of these prospectus that are out there about particular funds. How long are they, Dave? They're like this thick.
Yeah.
Good luck. I would never read anything like that. I got to read the fund fact sheet, which is like one page, and I'm lucky if I read all of that.
Correct. And I read them for a living. I've stopped reading, any other books. I read PPMs for a living. And I tend to enjoy it because I find so much. So risk is a good factor. So if you were to ask me about risk, I'd define it as standard deviation. How many of your listeners understand what standard deviation is? And is standard deviation the only measure of risk? The answer is no. Is the bell curve the probability-driven item, which we all use? But is the bell curve the normal curve? The answer is no, it's not. It never is. It never, ever is. Are the black swans the deriving factors? No, they're not. They're not. So.
Yeah, look, I always come out of these discussions. I actually get smarter by listening to our guests, and I think I actually understand a little bit more about risk that we just talked about it. Dave, unfortunately, we're going to have to leave it there, but I get a sense that we're going to be talking about this issue, you and I, for a long period to come. I want to thank you so much for joining us on the program this morning, and we look forward to having you back on the program again very soon.
Thank you. Thanks a lot, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN Weekly. We'll have a very special guest, and we'll take a look at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.